Good morning, shiny happy people. Melissa with White Diamond Realty here, bringing you part 3 of my 3-part series on real estate investment. And today we're going to talk about the T word, taxes. Love them or hate them, we got to pay them, right? So we're going to talk a little bit about that, okay? So I'm going to go ahead and share my screen, did another PowerPoint for this one because I think it's really good for this platform. So let's get started now. So we're going to talk here. We're going to talk about different types of taxes, what you can do about, paying them, exempting, all that good stuff. Now, this first slide that I'm going to go through, that I'm going to pull up, is the most important slide that you will see in this entire presentation. So get ready to take notes. All right, ready? Here it is. I am not a financial advisor, tax professional, or attorney. So the information I'm giving you here is very general and broad. The next slide I'm going to show you is the second most important slide of this entire presentation. And that is, if you are considering investing in real estate, you need to consult a financial advisor, tax professional, or attorney. One of the three, all of the three, some of the three, you need to really consult with professionals in addition to your real estate professional, your financial professionals, as well as an attorney. Okay, so first we're going to talk about what these taxes are called. So these are called capital gains taxes. So when you invest in real estate, there are two types of capital gains taxes that you could potentially be taxed on. One is short-term capital gains. So if you own the property for less than 1 year, any less than 1 year, you're going to pay what's called short-term capital gains, which is a slightly higher tax rate than the next category, which is long-term capital gains. So if you own it for any more than a year, 2 years or more, then you're going to pay long-term capital gains on it, which is slightly less of a tax bracket. So a little more on the short term than on the long-term capital gains taxes. Now, the capital gains are calculated on your net profit. So it is not just what you paid for the property minus, what you sold the property for minus what you paid for the property. It takes into account any and all of your expenses. So make sure if you're doing an investment property that you're doing improvements on, or if you're holding on to it long time, keep very detailed records of any money that you spend on the property. Improvements, repairs, carpeting, taxes, paying professionals to maintain your property, all of that stuff could drop that amount that you're being taxed on down. So keep very detailed records. This is where your accountant, financial advisor, and attorneys come in. Keep very detailed record on all of your expenses in any of your investment properties. So when you do sell them, whether it's short-term or long-term gains, you're getting taxed on the lesser amount of what you sold it for versus what you have invested in the property. Very, very important. Okay, so let's talk about exemption. Can you be exempt from paying taxes when you sell a property? You absolutely can, if it's your primary residence. Okay, so you bought a house, it's your primary residence, you have claimed it and lived in it as your primary residence for at least 2 years of the past 5 years is the current law. So if you've owned it and lived in it for the past 2 years, you're good. If you've owned it and lived in it, then moved out, maybe rented it for a couple of years, but within that 5-year window, you claimed it as your primary residence and actually used it as your primary residence for 2 years, you could very potentially be exempt from paying taxes on the gains. Now, rules of that currently are, if you are a single person who owns the property, you are exempt from any gains on the sale of that property up to $250,000. If you make more than $250,000 on it, you are taxed on anything above that $250,000 threshold. In this instance, this would be long-term gains, so it would be the lesser of the tax amount. If you are married and you own the property jointly, that amount is $500,000. So you can make a fair amount. So a lot of people do that. They will buy fixer-uppers. They'll live in them for a couple of years, fix them up while they're in there, turn around, sell them, take that equity, buy the next one. So that is how you are exempt from paying taxes. Now you can also defer the taxes. This means you push it away. You don't have to pay taxes right now. You defer those taxes until a later date when you liquidate your assets. This is called a 1031 exchange. It's very important that you have an attorney and an accountant with you along this journey, and or an accountant, I guess one or the other, but at the very least you want an attorney, probably an accountant as well in this journey. There are a lot of very strict rules with this 1031 exchange, but it's a really good way to take the money that you have made on the property that you're selling and immediately transfer it into your next investment. If you immediately transfer it into your next investment, stay within the guidelines of the tax law, then you do not have to pay property tax, excuse me, you do not have to pay taxes on that profit until a later date. So it's called a 1031 exchange. So this is very common. I'm going to go ahead and stop sharing my screen. This is very common that people, they'll sell property. It has to be a like kind exchange. So it has to be similar to what you're selling. Doesn't mean it has to be the exact same thing, but it needs to be real estate for real estate or something similar to thereof. Attorneys and accountants, this is where it comes in. But you take all of the money that you make on it, the net profit that you make on it, you immediately put it in to the next property that you're going to buy. So this needs to be timed really well. You need to work with your real estate professional and your tax professional and your legal counsel to make sure that you are doing everything within those guidelines, because as soon as you are one day outside of those guidelines, you're done. You can't exchange it. You have to pay the tax penalty on that. So very brief overview of the taxes when you are a real estate investor. Very brief overview remember, I am not a what? I am not a tax professional, financial advisor, or attorney. So make sure that you consult with those folks, but you do need to be prepared for the tax implications of real estate investment. Doesn't mean you shouldn't do it, just means you have to be prepared for it. It's one of the expenses, right? Just, you gotta pay Uncle Sam. He pays those roads, he builds those schools, all that good stuff. So that's my 3-part series in real estate investment. I hope you've enjoyed it as much as I have. I hope it was helpful and enlightening for you. And if you have any further questions, please don't hesitate to reach out. Happy to fill in any blanks that you have. Take care and enjoy your day. Shiny, happy people. See ya.